I know this is going to be hard to accept, especially considering the economic backdrop and some of the very real challenges we face, but the lows for the market this year are in. Look, I know you think I'm crazy, but trust me, you're not alone. I've gone off the deep end a few times, but there's a method to the madness. Hear me out. Welcome to the Money Runner. I'm David Nelson. We've had 4 straight weeks of gains in the S&P 500, and traders are looking for just about any excuse to lock in profits. But there's a lot of performance anxiety right now. Investors hate losing money, but what they hate even more is sitting on the sidelines when markets are heading higher. A lot of open-end and exchange-traded funds have all fallen behind the market, and investors are looking for any opportunity to catch up. Listen to what I'm saying. I didn't say the market couldn't go down or even that the bear market is over. What I'm saying is that the June lows, that's the new reference point, and pullbacks are going to get bought. At the bottom, there was record low exposure, and a lot of strategies got caught flat-footed. Look, investors get upset with a portfolio manager or advisor when they lose money. And if they lose more money than the market, they get even more upset. But miss the rally completely, or even worse, end the year with the market up and you're down, that's how you get fired. And a lot of professionals aren't going to take that chance. There are no rules. There are some guidelines for sure, and they should be looked to. But markets can stay irrational a lot longer than you'd expect. This entire earnings season has been somewhat irrational. But it's also the kind of trading action I've seen in other bear markets like 2009 and post the dot-com bust. Company after company this quarter reported disappointing earnings. In many cases, those stocks went higher. Apple, Microsoft, Alphabet, and Amazon, those earnings reports were nothing to write home about, but Apple's profits alone were down 11% year on year, and Amazon reported a $2 billion loss, yet these stocks went higher. When stocks stop going down on bad news, that's often a good sign, and sometimes even an inflection point. All right, so what should we look to for some guidance on how to reposition? Well, for now, the offense is on the field. Make no mistake, a pullback, that can be significant. But I'm saying right now there are buyers at levels below this. A 50% retracement, that would take us back to about 39.70 in the S&P 500. That's about a 7 to 8% pullback. That's pretty significant. What about the economic backdrop? I'm asking you to invest money right now. So what's the economic backdrop for the next 6 months? Well, for now, we're just coming out of recession and we're hovering above stall speed. We've had 2 back-to-back quarters of negative GDP, and right now consensus for growth in the second half of the year is about 1.5% for Q3 and Q4. The challenge and risk is for next year. The possibility of a recession next year is real, but that's 6 months from now. Today, inflation is still 8.5%. Yeah, it's better than expected, but a long way from the Fed's target of 2%. Even if we manage to make it down to 5%, say the first quarter next year, you can make the case that the Fed could take their foot off the brake, but they can't cut rates, and that means tighter financial conditions. What could derail this train between now and the end of the year? I'm asking to invest, so we need to know the risks. Well, this earnings season is just about over, and the next catalyst, I think, will be October when these companies start to report Q3 earnings. No, they can't get away with what they did this quarter, but the good news is that analysts have started lowering the bar. Earnings season is often an expectations game, and we need to see these estimates come in a lot lower. Look at that chart. That green line on top is analyst estimates. That's starting to roll over. A lot of disconnect in the first part of the year. We're going to have to justify this equity exposure that we've added. What else could derail this train? Well, almost anything. Every corner of the planet's a geopolitical hotspot, but energy is always high on my list. Look at China. Oil was down today after China announced they were cutting rates due to the slowdown from President Xi's zero COVID policy. Look, China is the second largest economy on the planet. So if they continue to slow, it may not matter what's going on here in the States. On the other side of that dynamic, what could drive oil higher? Right now, the administration has been selling 1 million barrels of crude a day, and all in will have sold 180 million barrels by the election. They obviously can't sustain that, and in fact, they're going to have to replace it. Another conflict or natural disaster, that could leave us without a backstop. If that happens, then all bets are off it, and my call's likely wrong. Finally, what's a good signal to use that could help us make a mid-course correction or even turn back? Here's one I've been using for most of my career, the New York Stock Exchange Bullish Percent Index. Very simple, useful tool. You can find it for free on stockcharts.com. When the chart is in a column of X's on the right, the number of stocks of the NYSE with a point and figure buy signal, that's rising, and the offense is on the field. When it's in a column of O's and falling, that's when it's time to get defensive. All right, we covered a lot of ground today, a lot of economic data and a lot of theory. Please feel free to reach out with any questions. And if you'd like more info on any of the charts or data, send me a message on the Money Runner site and sign up. I'll see you again next week. And of course, every morning for the Market Minute. Thanks for joining. I'm David Nelson.